anyways, what's going on today? There's not so much going on in the way of large price action.
No, but some interesting divergence here. Euro actually holding in above 105. Is it a rally? It's not putting in new lows. Sterling actually rolling over a little bit. So we're seeing a little bit movement across this. Now we're in a story of where's the dollar? It's kind of flat. Yen's up a little bit. Sterling's down a little bit. Aussie's bouncing a little bit off of its lows. None of them to a big degree. But as traders, we're getting two-way action, which is what we want. So you can trade a little bit of both sides of the market. But we're definitely seeing sterling underperform euro right now. Swiss and yen, both. Swiss is finally getting some legs out of it. Dollar Swiss getting sold a little bit lower, but nothing moving by huge chunks right now.
Yeah, not a bunch of big action, but a little bit of reversal from yesterday. Yesterday throughout the day you just saw, and let's actually take a look at some of this movement if we dive deeper into something like Aussie.
That's interesting too, yeah.
Because yesterday, I believe if I have this right, here's Monday, huge sell-off as we were ending the show.
Right.
And then just continuation throughout the U.S. Open, got all the way down to 64.50. And then a decent bounce here of 20, 30 pips by the end of the day. And then today, continuing to bounce back a little bit throughout Asia and Europe, and now giving back a little bit of ground here. But what's interesting, Pete, is yesterday seemed like a classic outside day with some mean reversion. And what I mean by that is you and I'll never forget this guy, Gene, who is the risk manager at the prop shop I worked at the Chicago Board of Trade. And he, of course, I studied math, and so like all this modeling of markets and everything else. And he was this like older guy who I'm sure had seen everything. And he was like, you really just have to think about things like a rubber band. And sometimes the rubber band expands and it comes back, and sometimes the rubber band expands and it breaks. And that's really it. And that's all that we're doing here, because we were trading treasury spreads, a ton of spreads. And so when you're spreading off all these markets against each other, the theory, at least at that firm, is that if you're trading, I was trading Asia and Europe, if you're trading whatever sessions and you're getting flat by the end of the day, that like everything should pretty much equal out.
Right. And again, spread trading is pairs trading. It's mean reversion. So same thing there. You're just trading different maturities within the treasury cycle.
And we're not too far from that when it comes to currencies here, because you can see that there are two markets that have a slash in between them, and they're seen, it's a forex pair, right? And so that being said, you do tend to see, Pete, that the rubber band expands and then comes back more often than not. We talk about standard deviations, and just by a pure probabilistic mode, you're talking about a 68% of the time it stays within this range, and a 32% of the time it goes out of that range. That's one standard deviation. And the one standard deviation, I'm sure you did this with Glenn in the last couple of weeks, in Aussie, I'm just going to say back of the envelope math is probably around 40, 50 pips.
Yeah.
And so yesterday, Aussie being down, I think it was, down at certain points like 60, 70 pips. So outside of that standard deviation, at that point, when it was, down here at 64.60 and 64.50, kind of the outside territory, one of two things is going to happen.
Right.
It's either going to expand and break, and we're going to close down here at 64.50 or even further, 64.40. Anything can happen, obviously. Or it's going to contract a little bit, and the market is going to say that was actually too much. Especially you see a move like this, Pete, where they're selling going into the U.S., and then on the U.S. Open, they're really trying to push it.
Yep.
And then they can continue to push it. But a lot of times you'll see, okay, we pushed it here. It was a little bit too far. And then you see the bounce of 20, 30 pips back into what's inside territory. And so yesterday, a really classic example of, a good contrarian day or a mean reversion day or a normal day, as Gene at the Chicago Board of Trade would say.
great walkthrough. And this is why we look at, and you highlighted it perfectly, the one standard deviation range is it takes that 50-50 bet and makes it 68%. Now, that's 68% of the time the market stays within that range long term. So you have to accept that 32% of the time it will continue to move. But that, if you think about it, that in and of itself as a tool for reversion traders, for people trading extremes, is a powerful dynamic. If you can, you pair that with disciplined metrics, with disciplined profit and loss targets, you've started to develop something that has potential to have edge for you.
Yeah.
But that is, again, one set of tools that you can use to take advantage of market movements like this and put scale around. What I love about this is, having traded so many different things in 40 years, the hardest thing for us was when the markets started to experience a run. Volatility would expand. That one standard deviation, we weren't looking at numbers back then. We were all kind of just gut checking.
You were doing it without.
And we were used to fading a 30 pip or 40 pip range, but the market was giving you 100 a day. Adjusting your methodology was a painful exercise because you were too involved too early and usually sitting on bad positions. By being able to look at that, and that it's a dynamic indicator that gives you a sense of basically what opportunity the market provides for you. So that is a nice piece of context to have. And different markets give you different elasticity depending on the volatility. And that's what that provides for you. So it's a nice way. It's one we often reference as a valuable tool. Again, not a guarantee, not the single thing we base our decisions on, but it's a tool. It's part of our decision making.
Well, and it helps with decision making in a number of ways, which I'll get to in a second. But just to hammer on Pete's point there, these things absolutely do change. For example, here in the summer and spring of this year, when we saw some really low volatility,
right,
the standard deviation in this Aussie market is probably more honestly like 20 or 30 pips. Getting into the fall here, it started to heat up, but really still nothing outside of the normal. And you were still looking.
But this heated up a lot more than Euro did.
Yeah, especially going into the election, and then now post-election, there's been some big moves as well.
Because if we know that we have liquid markets to trade and tight bid-ask spreads, I should be able to move to them from Euro to Aussie to Canada to whatever is giving me that elasticity and that bigger reversion to play pretty comfortably. And when we were down to 21 ticks in the Euro, and I went back to Glenn, Glenn, run the numbers, you're wrong, it can't be that small. And it actually was. And what that tells me as a trader, nobody's going to be, 21 ticks is so tight, no one is going to be able to pick the right 10 or 11 to trade in that range. So better, let's find something with more or less. So here was a case where if Euro was your primary market, you might look at adding another currency to trade because it did provide you a better opportunity around ranges.
Yeah, and you saw a similar thing here in here's the euro dollar market, and what Pete's talking about is when the ranges were really small in here, where you had like one or two big days. This was probably like a Fed. No, that was non-farm probably. That's a Friday. Yeah, first Friday in June there. You had one or two big days, but look at all of these just like 20, 30 pip days and less. But if I go back down to the 15-minute chart, you'll see a similar thing to what we were just looking at with Aussie, where you have the big sell-off here to start the week, right, and then a bounce back throughout yesterday. And then, Euro, you're right, is holding a little bit stronger here to start today's session than Aussie, at least, in sterling. But it also, something like this, Pete, illuminates a bunch of different things, because let's say you were short Aussie yesterday. You were short from a trade from a week ago or 2 weeks ago, right, or 2 months ago, because you had a great hunch that Aussie was going to move lower.
Yes,
would have been a great trade, and to hold all the way until yesterday, good for you. But let's say you were short from just last week. Okay, you thought there was more room for that Aussie to run, and then you saw yesterday that there was a huge move to the downside, and you knew, okay, a normal day in Aussie is, 40, 50 pips. This market's down 70. I'm going to cover some in this move. And, if I get the ability to sell them again later in the day or today or later this week, then great. But I know at least I'm covering, in a relatively big move in my favor. You know what I'm saying? Because it works both ways, that if you're flat and you're looking to enter something at an extreme, that's your type of trade, right, then great. But also if you have positions on and they're working in your favor in an extreme way, that might be a point where it's like, okay, I should stop being greedy here, or this is just a good opportunity for me to get out. But I do agree with you, and maybe this is a last piece that we cover.
This is one thing we see, and that people struggle with. It doesn't have to be all or nothing. You get that down move, you're right the market, you get to that extreme, you can cover half. Mm-hmm. Yeah. It seems that, especially new traders and having mentored so many traders, it's always this binary outcome. I got to either have them all on or all off. Mm-hmm. And that's not the case. And so, yeah, you may still think there's room to the downside to go on all these. Mm-hmm. In terms of dollar strength and currency weakness, managing a portion of them, there's nothing wrong with that at all. And using those type of numbers to do that is a really effective way to start to, I've seen so many guys who have either on the winning side or the losing side, taking half of them off. And yeah, if you're long and you're covering losers, sometimes you'll sell at just the opposite at the low, and that always stings. But more often than not, what you will have done is taken half off, the market continues to go, and you're in a better mental space to manage the balance of that trade. And you can look at that, and I've seen guys who've taken winners off. It's like, take half off and have that be the worst trade of your life, and have the market continue to go. So looking at that as a tool to start managing position size and portionality is something we always need to be thinking about.
Well, and I think it'd be nice if we close on something that you touched on, but is essential to this, because again, and now we're in the euro dollar market, and again, this was a different market yesterday, obviously, than that Aussie, but a really similar move in that this, at certain points, 100 pips sell-off to start the week, when you include Sunday's action and Monday's action, outside of the norm.
Right.
Euro dollar, I would say, because it has heated up recently, is probably more like a 50 to 60 pip range the last handful of weeks. Agreed. Here. But still, everything here, everything below 105 really was outside of a daily normal range, we would say. And so let's say you did, put on this trade, you bought at 105 or 104.90 or 104.80, or you pinned the low down here at 104.60 or 104.70, anywhere in there outside of that normal range. Now, what is essential to this, because a bad thing can happen even if you have the 68.32 in your favor, which is in that 32, there's no guarantee that the loss that you might incur, whether you're buying into a down move or selling into an up move, is the same as the profit you would incur on the 68 side. In fact, there are a number of black swan funds and traders out there that will take 68% losers because, 32% of the time they're taking bigger winners. Right. And that's what trend followers are telling themselves and strategizing about a lot of times. So if you do use this tool and you do trade that way, you probably would benefit from a set of mechanics that are relatively strict, that it is like, okay, if I bought down here at 104.80 and I was going to hold for, a 30 pip rally, which you would have got up here to 105.10, I'm only holding for a 30 pip loss to the downside.
You've got to have some structure, and I think you hit on a great point. Making decisions on Delta 1, static delta scalping, making those decisions ahead of time is really important to staying mechanical. You're more likely to stay mechanical and not let the outsized losers consume the gainers by making those decisions ahead of time. sticking to them in the moment. When they get down there, it looks like, oh, it can't go any lower till it does. But that will help you stay mechanical. And you're right. That's part of the statistics work if you use them both in a way to identify opportunity, but also to define loss.
Well, yeah, you can't only use them in a profitable way.
Right.
And then essentially just black tape all of the losing positions. Or, and I've seen, we've done this.
Yes.
Where it's you have a good month or you have a good year or whatever, and then you not only, buy the 105s and then they fall to 450 and they're already outside of what you normally would have done.
Right.
But then you buy another one.
Right.
And you buy another one. And that is how you undo weeks
a lot of good
or
work.
months
Right.
of using those statistics in the profitable favor, because there's going to be those 32% losers, Pete. But you can't let those become asymmetric losses to what's been a static, consistent profit. So an interesting day yesterday. Hopefully we get more days like that where you get some outside of the normal moves. It doesn't always come back, but yesterday it did come back, and we're seeing this euro dollar continue to come back a little bit here today. We'll see if 105 holds.
Yeah, and it'll be interesting to see rolling through the U.S. equity opening whether or not we see that selling come in and pound it again, or we actually see some two-sided risk come back into the market. But lots of interesting pieces. Stay tuned. We'll be back with you tomorrow. Have a great day.